What's up everybody, Nate here. And over the last 2 weeks or so, the stock market has been in the green and has been on one of its biggest bull runs since 2017. Now, just before this, it was coming off of one of its longest bear markets in history. But something switched along the way, and now every major index is going up and is setting new record highs, which got me thinking, how could this possibly be? You have economists and investors saying that our economy is nearing a recession. Meanwhile, we've had mass layoffs and record high inflation, making the price of things going up, scaring off consumers. So why exactly is the stock market going up despite all of that? Well, today we're going to be breaking down the three major things that are sort of driving prices upward right now, and we're going to go over everything you need to know as an investor and just a consumer in today's economy. Now, the first thing you need to understand about the stock market is the effects that inflation has on it. So inflation basically means that the prices for goods and services are steadily rising over time. Inflation in the United States back in 2021 and in parts of 2022 was setting record highs. We actually saw inflation of around 9% last summer. Like I said before, that means that prices are going up, which means people have to pay more for things, and that means pretty much everything in our economy also goes up, and that includes the prices for assets. When you have high inflation, well, you're naturally going to have high asset prices because you're going to have a lot of corporations and businesses setting new record highs for their revenue because people are spending a lot more money at their locations. People might not be getting as much, but they're spending more because each individual item costs a lot more to produce, because that is exactly what inflation does to our economy. Inflation is going to make it much more expensive for everybody to do business and for consumers to buy things, because now as people buy more of things, well, businesses only have a certain amount of inventory available, so they need to produce more, but that comes at a cost, and that means they have to go out and hire more workers, and they have to pay people more because the prices for things have gone up, and that costs a business a lot of money, so naturally their prices are also going to go up, and eventually people need a lot more money to buy things, and you just have this system called the wage price spiral. Well, that has been going on now for around 1.5 to 2 years. Wages have been going up. Meanwhile, the prices for goods and services also has been rising, which means inflation is going up too, as investors have to spend a lot more on assets in the United States. So stocks, bonds, all of those different investments are going to go up in value because inflation is also high. Of course, the value of those things is cut away a little bit because inflation is a lot higher and you have to spend a lot more to get that asset. But at the end of the day, this is a short-term problem for the stock market because they want to continue to see the prices for all of their assets going up over time. So even though part of this rally has been inflation induced, a lot of investors want to continue to pile in because going up is a good sign. Going up means more profits. Going up potentially could mean more dividends for certain stocks. So they want to continue to see earnings reports that are positive and showing profits and new revenue, and they want to continue to see the stock market go up in general. So a lot of investors have been pouring their money in because everything is starting to go up right now. But inflation is not the only thing that affects the stock market, and it's not the only thing that has been affecting the stock market over the last couple of weeks. Now, the second thing that's been affecting the stock market over the last couple of weeks is the Federal Reserve. Now, the Federal Reserve is basically in charge of a lot of our monetary policy here in the United States. They are an independent body separate from the federal government, so they're not technically the ones that are printing money, but they're the ones that tell the Treasury Department how much the Treasury needs to print. And they have contributed to inflation pretty much more than anyone else. Inflation became a problem back in 2021 and 2022, but inflation didn't just become a problem by itself. Inflation is caused by excessive money printing. So when you have too much money in your economy, well, that creates excess spending because the vast majority of Americans, when they get a large sum of money, when they have extra money in their paycheck, well, they go out and spend this money. Now, normally, if it's just a couple Americans or a few million Americans who have a lot more money all at once, well, they're just going to spend that money and it's not going to have a drastic impact on our economy. But what if it's every single person? Well, that is what we've been facing over the last couple of years as the United States government gave out stimulus checks and also had a lot of financial stimulus programs like the mortgage moratorium program and extended unemployment benefits for pretty much every American. That meant a lot more money was getting poured into our economy and spending essentially went up, which drove the stock market up a lot all at once. What we saw pretty much immediately was asset prices going way up. So the stock market went way up in price and pretty much all of the values on Wall Street went up very quickly. But then in 2022, we had a bear market, and the major reason for this is because we had a lot of layoffs and we also had a lot of Americans who were basically running out of money. The Federal Reserve printed a lot of money during this time, but eventually people started to run out of those funds. And when the Federal Reserve essentially cut off everything at the end of last year, well, that is what created the bear market. Now we didn't have the mortgage moratorium program anymore. Now we didn't have those stimulus payments. Now we didn't have those extended unemployment benefits. So Americans were starting to level out their spending. What's happening in 2023 though is a lot of that spending is now starting to even out even more, because in 2022 people were still spending a lot of money because they had a lot of money, but now inflation is starting to come down because the prices for everything were out of control, so people weren't able to buy as much, so they stopped spending altogether. But today they're starting to spend at a regular pace again because inflation is also starting to come down. What that means is the prices for goods and services aren't drastically going up and up and up every single month. They're basically staying the same, so Americans know what they can afford, and that steady spending is what is partially driving the stock market. And of course, the other thing that has a lot to do with inflation is supply and demand inflation. This comes and goes in our economy, and it can even come and go in certain industries. Like if you have a sudden huge spike for, let's say, video games, well, the prices for video games might suddenly go up very quickly, but that doesn't mean that everything in our economy is going up in price. It's just affecting that one specific niche in our economy, and eventually once whatever was causing the demand to spike in the first place goes away, then prices will probably follow suit. Like I said, we had demand for everything because everybody in our economy had a lot more money, and also we had issues with the pandemic where businesses weren't able to produce as much, so there was a scarcity on certain objects, which also drove up inflation very quickly. A lot, I would venture to say actually most of those factors are non-existent in our economy anymore as the pandemic has taken a back seat. People are working and making goods and services. Businesses have a lot more access to things, so inventories are pretty good too, and spending is also starting to level out, so inflation is going down. Now, I kind of went on an entire tangent there, but the Federal Reserve has a big role in our economy, and it has a big role on what prices and values are going to look like in the stock market. Once the Federal Reserve realized that inflation was a big issue in our economy, well, now they've been doing everything in order to try to lower it. The Federal Reserve doesn't have a lot of power, especially once those dollars are out there, but the biggest thing that they can affect is supply and demand. They can decide how many dollars are out there, and they can also decide how easily those dollars can be spent with their interest rates. Since all money comes from the federal government because the government is a currency producer, well, that means it trickles down to banks, and then that money trickles down to Americans and businesses. Well, if the Federal Reserve has a really high lending rate, well, that means it's harder for banks to get their money, which means it's harder for people to borrow money. So interest rates for things like mortgages, interest rates for things like car loans and personal loans and credit cards goes way up, and interest rates have been jacked up pretty high over the last year or two. That affects everybody because now not as many mortgages are being bought, not as many cars are being bought, and not as many things are being bought in general because Americans can't spend on a credit card. It's just simply way too expensive. And people are going to be priced out of certain markets because you can't get a mortgage if mortgage interest rates are 6, 7, and 8%, which is close to where they are right now. How does that all affect Wall Street? Well, if businesses are having a hard time, well, Wall Street and the stock market is made up of businesses. So if investors can't borrow money because it's harder to borrow money, then they're just not going to, which makes it difficult for stock prices to go up because nobody is buying any stocks. There just isn't enough demand versus the supply. Now, the Federal Reserve has been partially causing the stock market to go down over the last year, but now it's causing the stock market to go up because instead of raising its interest rates and making it a lot harder for people to borrow money, it paused interest rates last month, meaning that it's not continuing to raise them. So investors have a little bit of a better idea about how much they can invest. They know the risk there, which means a lot of them are getting a little bit more eager and anticipating that rates could eventually go down, something that the Federal Reserve has talked a little bit about. Investors are anticipating that the Fed is not really going to raise interest rates much higher from here, which means it's safe to invest. Investors now know what is at stake, and they know the risks to investing in this current economy because they have an idea of what the Federal Reserve is going to do with its interest rate policies. And they believe that the future is bright for interest rates and the Federal Reserve, so a lot of investors are trying to get in right now because this is the early time to do so. Stock prices might be a little undervalued because interest rates are so high. Investors want to get in before there's potentially more inflation, before there's potentially more spending, and before interest rates get cut or go down, leading to values going up, because now it's a lot easier for everybody to invest. And the third and final thing that is absolutely crucial for you to understand about this stock market bull run is that the stock market is completely separate from the economy. The way that I like to think about it is the economy is today and the economy is in the past. Like when we measure the economy, we look at GDP, which is what the last quarter did. And it takes into account basically everything that everybody did and produced in our economy. But what you can't do with the economy is measure the future. Sure, we can have projections, but nobody really knows what is going to go down, because what determines a positive economy and a negative economy is a million different little factors. Not to mention the economy, whether it's doing really well or doing bad, really just depends on your own personal views. The stock market, however, is a little bit more cut and dry, and you have a much smaller sample size. For instance, the stock market is made up of only a few hundred different companies, right? So that is what you're going to be measuring your success on. What the stock market is all about is investing, and investing means buying something today and hoping it goes up in value for tomorrow, so that way you can make some type of profit on it. The stock market isn't really worried about what exactly is happening right now in our economy. The stock market is more concerned with what's going to happen a month from now, or 10 months from now, or 10 years from now. I think a lot of Americans have a misconception of what the stock market actually is. They think it's just a place for people to make a lot of money. But what the stock market is actually is it's a place for people to invest in specific companies. You are buying a paper share of a specific company because you believe in the value of that company and you believe that the value is going to continue to go up. Investors want to continue to see the value of those specific companies going up, so they don't really care what happens with the economy. They care what happens with, say, Apple stock or Microsoft stock or Walmart. If those companies are doing well, then that can kind of give us a very small view into how the economy is performing. And if they're not, well, the same thing applies. But if those companies are doing really well or really bad, isn't necessarily to say the economy is doing bad too. So as long as earnings are going up and there's still positive revenue and there's still positive innovations for a lot of these different companies on the stock market, well, then you're going to continue to see the stock market go up, because a lot of investors want to keep pouring their money in if money just keeps coming out. And this overall is a really good sign for our economy and the stock market in general, because despite all of this craziness that we've had in our economy, like big layoffs and lots of inflation, the stock market is still going up because investors believe that the future of our economy is looking good. And the basic train of thought here is that investors don't want to lose money. So if you see investors pulling out, then that could potentially be a bad sign for everybody, because that means that investors believe that a lot of money is about to be lost. But with investors continuing to just pour more money and pour more money in there, well, that could mean that they believe that more money-making opportunities are on the horizon, and that our economy and the stock market and businesses are extremely resilient and are starting to adapt with new innovations in our economy of today. And like I said before, that is a really good sign for everybody right now. Now, obviously, I can't guarantee that the stock market is going to continue to go up or the economy is going to go in a good direction either. So always do your due diligence when investing in anything, and always do your research when it comes to investing in stocks and just spending your money in general. Never listen to random people on the internet, including me. Always do your own due diligence before spending any money or investing. Let me know your thoughts on this in the comments below. Do you think that the stock market bull run that we're in right now is going to turn into a bear market soon? Or do you think that this stock market bull run is going to continue to go up and set new record highs throughout the rest of 2023? That is it for me, everybody. Be kind out there, and I'll see you all in the next one.